Alan.
Al Lewison.
Welcome to today's Wealth WOD.
I want to talk to you today, guys, about something very big and very scary called the banks.
Ooh, the banks.
So just recently, in the last couple of weeks, my little 5-year-old, Tommy, he's learnt to ride his bike without training wheels. And
Well done, Tommy.
Well done, Tommy. It's funny the conclusions you can draw to things, because in the same week we had someone coming, actually via a question, Wallace, thank you, saying...
William Wallace.
Yeah, William Wallace. That's what we've been saying in the office. Saying the banks are pretty scary. I'm confused. I've got my second loan, but I'm just really worried about them. And what it got me to thinking is, like riding a bike, as he's learning to ride the bike, I was watching him, his first nervous pedals, worrying about falling off, to a week later being really capable of it. And it's just about repetition and redoing it. And Wallace coming through with the same sort of fear about something that he'll get better at, you get more comfortable with, but you need to go through the steps a few times to understand it. So we thought we'd talk today about the big scary banks, and specifically around different levels in the bank, different criteria. But the one thing for me, guys, that it took me a little while to work out was that fundamentally the banks are in business to lend you money.
Yeah.
So the banks want to be giving out money. That's what they do. If they didn't give money out, they wouldn't have a business.
Yeah.
So you need to just work in their parameters, understand them, and then find a way to fit around them, provide them what they need to give you the money.
Yeah, it's up to you, or your broker, or your relationship manager at the bank, to sell you and your investment to the credit department as a safe investment opportunity, to low risk.
Yep.
I often found, early days when Ella and I were in business, I find I'm more of a visual person. So once I can see it on a page, I can understand it, I can dissect whatever the information is. So I like things in visuals. Same when we get together with a team of accountants or lawyers, they'll be throwing different, I go, just get it on one page for me so I can understand it. So I've drawn out what a bank looks like internally, and banks vary a little bit, but this is how the majority of the major four look internally. So if you can see this one. So this is the area where most people, yeah, this is the retail space or the consumer space where most, or all home loans go basically. This is 95% of the market, and you can get an 85 to 90% loan to value ratio. Once you get a bit of, you start building a bit of wealth, or as the second you've got a business, you get thrown into this area, which is the commercial or business banking area. Now they land up to about 30 mil, and this is where a lot of people get trapped. This is where the banks like to keep you, because it's a safer area for them, and they'll lend at about up to about a 75% LVR. So, and the interest rates are slightly higher in here. This is where they make their cream. So this is where a lot of money is. Going further from that, you've got the corporate area, so lending up to about 100 mil, and then it goes to institutional lending, which is serious coin. This mystery area over here, which a lot of people don't know about, is what's called private bank, which is personal wealth, where personal wealth comes. So you might have individuals in these three areas who get invited across into the private banking sector. So anyone in commercial or business, worthwhile talking about getting across to the private bank, because different rules apply there. You can build really good relationships in those areas, and people can really help you out and work with you on what you're trying to achieve. It sort of starts out at about 2 mil, scratching the surface, lending upwards. But the good thing is you can get 80%, sometimes 90% LVR, so you're back into the game again.
So where most people sit is over here. They're going to buy an investment property, which is generally why people are watching the WODs, and they're going to sit here in the retail consumer space with a lend of 80 to 95%. Now, once you're above 80%, a little thing called mortgage insurance kicks in, LMI. Now, that puts some further rules and regulations on what the banks will do, and they have their own criteria needs to be met that can somewhat differ to the banks at times, depending who the LMI company is, but that's worth being aware of. Now, the other thing is, these rules and limits, guys, people might see it as the bank protecting themselves. They're also protecting people.
Yeah.
They're also protecting you, so that if things go bad, that there's a buffer there. There's some leverage there. There's some, a little bit of fat in it for you to be protected, that they're not going to come and say your asset's worth more or less, than your loan, things like that.
Hopefully it gives you a bit of an overview, guys.
Have a good day. Cheers.